Good afternoon, everyone, and welcome to today's webinar presentation, M&A Year in Review and What It Means for You. Before we get started, I'd like to review just a few housekeeping notes when it comes to the CPE offering today. We are offering 1 credit for today's presentation. To be eligible for that CPE credit, you must answer at least 3 of the 4 polling questions and have a total viewing time of 50 minutes. CPE will be available in 7 to 10 business days after the webinar. We are unable to grant CPE credit in cases where technical difficulty preclude eligibility. The CPE sponsorship guidelines prohibit us from issuing credit to those not verified by the technology and to have satisfied the minimum requirements as stated. And in accordance with the standards of the National Registry of CPE Sponsors, credit will be granted on a 50-minute hour. If you do experience technical difficulties with the polls, please answer in the chat. We'll be sure you are awarded the credit. And now it is my pleasure to introduce Twin Cities Executive Director Roseanne Bump. Welcome, Roseanne.
Thank you, Nancy. Welcome to all of our members, guests, and strategic partners. It's great to have all of you here today. As Nancy just mentioned, our session today is on M&A, the year in review and what it means for you. We'll be covering an M&A 2021 outlook, the impact of PPP on financial statements, and much more. Thank you to our partners from Redcat and Company today for working with us to bring us this session. Before we begin our program today, I want to take just a minute to highlight a couple of upcoming events. So next Thursday, February 4th, we're hosting a session on tech changes in a COVID world. COVID has put the spotlight on business technology, and it's not just Zoom implementations, remote desktop rollouts. Join Atomic Data CEO Jim Wolford to hear some real-world examples of technology investments Twin Cities businesses are making and debating in response to COVID-19. On February 9th, we have another M&A topic, how CFOs can prepare their owners for successful exit. In this presentation, hear from M&A experts, wealth planners, and a CEO whose company recently sold on the actions you can be taking today so that when the business you work for sells, the personal and corporate objectives of all key stakeholders are achieved. The topic will cover opportunities to streamline the sales process, strategies to position the business for sale, and estate planning strategies for owners to drive tax-efficient outcomes. More information on these and all of our upcoming events can be found at feitwincities.com. As many of you know, FEI is a nonprofit membership organization whose mission is to advance the success of senior finance professionals, their organizations, and the profession as a whole. We hope you will invite other senior finance executives to join us at an upcoming event or to learn more about membership. I'd like to now introduce Tom Hotnefield, Audit Partner, Client Manager, and Board Chair of Redcat and Company. Tom, all yours.
Thank you, Roseanne and Nancy, and welcome everyone to today's event. I've been with Redcat and Company for over 30 years. My background is in audit and accounting, and I do manage a lot of clients, and as part of that, I've seen and have been involved with a lot of mergers and acquisitions, especially on the seller side. And joining me today and leading today's presentation is Joe Hellman, who leads our transaction advisory services team, and also conveniently in a matching shirt, although mine has a button-down collar, so that's how you can tell us apart. So, Joe, take it away.
Thanks, Tom. Thanks, everyone, for joining. I am going to share screens quick.
While you're doing that, Joe, I'm going to pop up our first poll for our audience. Do you wish to earn CPE credit for today's program? I'll give you a few seconds to answer that. That's not a difficult poll.
All right.
And we'll give just a few seconds more.
Okay.
Thank you, folks. I'll end that poll and off to you, Joe. Thank you for your patience.
Thank you. So what we're going to first start with is just talking through trends that's happening in the market right now. This information that we're presenting, it's going to be a bit stale just because the timing of the deal activity in the report is always about a quarter lag. So we're showing activity through the third quarter, but in all reality, we have some good estimates of what happened in the fourth quarter. And it should come as no surprise to people here. When you're looking at this chart, you see a steep drop off right around the pandemic. So this would have been right after the first quarter. You see that drop off, you see some modest activity, but nothing significant. Deal count was still, call it 60% of what they had been. But then in the fourth quarter, what led to this was record-breaking fourth quarter. The last 2 weeks of 2020 saw record levels of deal activity, deal closing, volume, everything that was out there. And what this really meant was there's a big pent-up demand that happened. All the deals that were in process starting, April, May, June, if they were near the finish line, most closed. If it was something that was significantly impacted by the deal world or by pandemic, it paused, likely went, maybe even pencils down to the point where it died. But for the most part, those kind of sat in the back burner until the banks really had a good way to understand valuations. Once capital markets opened back up, then all those, it's almost like the floodgates open. All those pause deals, they came back to life. Unless there was a distressed situation, then we go into a different channel. But we really saw a pickup in activity once the capital markets started to figure out valuations again. In the fourth quarter, what we ended up seeing was a lot of, again, pent-up demand, but the fear of a change in administration. There was a bunch of rumbling about potential tax changes. If that happened, seeing capital gains increase significantly, that made a lot of sellers want to get to the market before any changes took place. So then we had that kind of perfect storm of a lot of cash that's out there. We had pent-up demand from the shutdown, and then we also had the kind of year-end rush of trying to beat any gains that would be coming up in the near future. When you look at the bottom table, what this shows is a lot of the activity happened in deal sizes of under 100 million. 72% of the deal activity this year ended up being add-on activity. So what that meant is there's a portfolio company that's doing smaller acquisitions just to add on and do some growth. In the past, that's been in the mid to upper 60s. So in the private equity world, you're seeing a lot more add-ons that were able to still close despite the fact that the pandemic was going on. We did have an interruption due to face-to-face meetings. Everyone was trying to learn through this, as is any of you. You probably also were trying to figure out how to best conduct business when you can't meet face-to-face. We were all trying to figure out how to do our jobs. How can you execute M&A in an environment where you can't be in front of each other? That was one of the biggest challenges we all were, we tried to work through. You all tried to work through. We've gotten pretty good at these virtual settings, but at the same time, it's very hard for businesses to be acquired if you don't have a chance to meet the management teams. And that still is a challenge. A lot of people are back on the road when it comes to the private equity and operators of these businesses, but a lot of the advisors still are doing things virtually.
Say, Joe, have you seen any trends within industries or any industries particularly hot or cold or anything right now?
Yeah, that's a good question, Tom. So, it really kind of went in waves based on where we were in the pandemic. Obviously, entering the pandemic, if you weren't essential, the deal activity just stopped because there's so much focus only on essential activity. That's where you saw the boom. Some business thrived, some businesses really suffered, some kind of stayed steady course. If we're to break it down besides just essential, non-essential, I would say the ones that remain the healthiest would be anything that is really around automation or healthcare automation technology, anything that's trying to help with kind of progressing your footprint and becoming more sophisticated. Those types of businesses have done very, very well. The ones that haven't done well are the ones that you need to be there in person. You need to be traveling, things like that. So that's going to be your hospitality, your retail. Those types of businesses have really suffered. But that should come as no surprise to most people. All right, so next we're going to get a little bit kind of a weird order because we're going to talk about the market, we're going to make some predictions, but then we're going to go into some topics that would impact all of you in your day-to-days. So now we're going to talk a little bit about what we see in 2021 and kind of, we have a few weeks here of activity to see if this is, at least pressure testing right. And this top chart, what this is presenting is S&P 500 cash. So cash that's available to be put to use as well as private equity dry powder. We find this meaningful because it helps us understand as we see this number growing, it's going to help us predict what type of activity are we going to see. What we talked a little bit about the pent-up demand. We talk a lot about S&P cash, and private equity dry powder, because that's ultimately money that we're monitoring to be put to use. When we, dry powder is not something that everyone may be familiar with. I use a lot of, call it, acronyms and M&A speak when I do a lot of my presentations, just because it kind of comes natural, stuff that we talk about every day. Dry powder is really just committed funds that need to be put to use. Private equity, they go out, raise the funds. As they're raising those funds, that's committed capital that they have. As they're going through the fundraising process, they have that committed capital that becomes cash in their pockets. Once they get that, that's when they start to invest in these businesses, acquire the businesses, start doing the growth thesis behind them, and then start returning money back to the investors. So as we look at this chart, you see a nice uptick from 16 to 17, relatively consistent, and then 20, we see a big jump here. This is just through the first quarter of 20. Dry powder is a little harder for us to actually be able to monitor. So as we look at this, the estimate right now is this, in the chart here, we're seeing about $1.3 trillion of dry powder. If we fast forward to where we are today, the best estimate that people are tracking out there is somewhere around $2 trillion. So you can see, as much as fundraising did slow a little bit, it's really popped up in the last, call it, 6 months of the year, which is going to lead to what we think is going to be the very robust M&A market for 21. So we have a few elements here. We have baby boomers that have been owning the businesses, running the business all day. Combine that with the pandemic, where people are starting to feel the pressure. They want to get through the pandemic. They're starting to see the light at the end of the tunnel and feel like they're getting to the point where, all right, I'm ready to be done with this. It's not something that I want to be involved with. There's been enough stress on me. And then you have a potential change in taxes. So because of that, we think all those combined are going to lead to a lot of exits by founders and entrepreneurs that have been in these businesses for years. We think valuations are going to sustain the levels they have. From a valuation front, we saw a big decrease in the first quarter, or in the second and third quarter. Big decrease in like a turn or two, so it wasn't massive, but it still was meaningful. Whereas the fourth quarter jumped back up to valuations prior to the pandemic, and even has kind of exceeded that. Some experts are actually predicting 20% of the deal activity that's going to be happening the next year is going to be 20x multiples. If that happens, that would be pretty amazing and astonishing. It's not something that I ever thought I'd really see, other than your traditional tech, biotech type deals. I still think that's going to be where most of those huge deals will be, but it's not to say that all of you should look at this valuation and say, hey, I should be getting 20x on my businesses. What it's really meant to do is just serve as a basis for you to think about what's happening in the valuation world. It's almost a reminder that, just so you remember, fair market value is what someone's willing to pay you. It's not necessarily what this business valuation came in at. It's not necessarily what your friend sold their business for. It really is what a willing buyer is going to pay you. And each deal is different. We'll talk about some of the enhancements and detractors when it comes to valuation a little later on. But in the perfect sense, your best assets are going to take the highest multiple. Your weaker assets are going to take a lower multiple. And then the last thing we'll really talk about here is alternative deal structures. This is where you start talking about SPACs, joint ventures, alliances, IPOs, even your direct listings. I think those are going to continue to surge just because of what we're seeing in the environment right now.
Say, Joe, we've got a question already on SPACs, and in particular, can you speak more to the impact that you expect SPACs to have and recent activity in the markets? And I'm going to add on to that. Can you help me understand what a SPAC is? I've seen them, I've read about them, and I think I've heard them described as open checkbooks. Take it away, please.
Yeah, so again, this is where probably me using a little bit too much acronym and M&A speak comes to play. So a SPAC is a special purpose acquisition company. They're very popular right now. It's not new. It's been around for years. You can track deal activity, I think, for probably 10 plus years for a SPAC. But what's new with them is every year people are looking at what's new out there. What's a new way to be able to raise capital and put it to use quickly? And if you go back to last year at this time, direct listings were the hot thing. They hadn't been popular for a while. But because of everything that was going on, direct listings became very popular. Fast forward a year, and now SPAC, it's the year of the SPAC. I don't remember what the trends were show, but if you were to look at a chart right now, this is about what it looks like when you go the first, call it 5, 6, 7 years, it's just very flat. Then all of a sudden this year, it goes up like this. And I think there's a few things that are contributing to that. One would be the fact that we had a shutdown. No one knew what valuations were. The debt markets dried up for a period of time. People were still raising funds. People were trying to find exit opportunities, and they were having to come up with alternatives. They weren't doing direct listings. The IPO market wasn't where they wanted it to be, and realistically, they weren't going to be getting deals done. So that they turned to the special purpose acquisition companies. And if you start looking at what's happening with those, these are things that they're regulated, but there's a lot less emphasis on current financials. For you to be able to go through the SPAC process, your financial statements do not go through the rigors of a traditional IPO. You don't have near the regulation. You don't have near the time, effort, and commitment up front. You don't have near the fees that are having to be paid to go through the process. So it's really the streamlined version of an IPO to get those funds. Once you get those funds, you have 2 years to put that to use. When you put that to use, great, everyone's happy. If you don't put it to use, then it's no longer going to be committed capital that's out there. But the challenge with it is, as much as it's not new, it's new enough that it's becoming so popular, the regulators are really going to have to start looking at this and figure out what do we do with these returns? How do we monitor this? How do we track it? Because I think this can continue to be popular, especially for these very large companies that are looking for exits. I think news came out yesterday where 4 of the last 5 huge SPACs over $1 billion that occurred, they were by some of your largest private equity firms that they had some good returns. They were looking to exit it. Instead of going to some of the traditional models, they exited through a SPAC, and they were able to do that whole process within 4 months. Traditional timelines for private equity is roughly 9 months. IPO processes can be even longer. And you're not having to go through the same type of rigors like SOX audits and all those. So there's a lot of differences here. I think they're going to continue to be popular, but I do think there's got to be some skepticism when you're looking at these. Okay, so I'll move on unless there's other questions that come in. And I'd encourage people, as you have questions, ask them real time. We're going to jump into a few different topics, but also want to be mindful that if you have a question, let's talk about it real time.
How about we do a quick poll, Joe?
Okay.
Okay, folks, next poll on the question. Have you ever been involved in an M&A transaction? This is a pretty easy one, and I'll give you just a few seconds to answer that.
So while we wait for the results to come in, we've talked a lot about the market. Now it comes down to what does it actually mean to you? There's a lot on this slide. I'm not going to read everything, but I'm going to summarize this top portion just to kind of put in perspective. It's a seller's market. Valuations are high. There's a lot of dry powder. It's very competitive out there because there's new funds being raised so frequently right now. What this all means is there's a lot of money to be put to use, and it's very competitive. So because of that, everyone should be looking at it and saying, when is the right time if we're looking to transition? We should start thinking about that and thinking about who do we talk to make sure we're being treated the right way. Some people, depending on your exit philosophy or what you want for your business, you may say, I want a proprietary deal. I don't want to go through the broad auction process. Some of you may say, I want maximum dollars. Each situation is different. You know what's best for you and your business. And that's why it's important to kind of go through this and think about it, not just have that random moment of, I need to get out and I need to get out now. These aren't short processes. They take time. In these competitive environments, what typically will happen is you're going to have both private equity and strategics. Here we're going to try to lay out a little bit of the differences between the two of them. So when we look at private equity, in that world, they're very much willing to put money up front prior to signing a deal up because they want to show commitment. So we'll typically go into those deals and have a phased approach where they may bring us in to do a quality of earnings on the front and do phase 1, make sure they feel good about the financials, get the LOI submitted. Once the LOI is signed, we jump in and do phase 2 diligence. The reason they do it that way is it shows there's a commitment. It shows they're willing to go fast. Where strategics, they typically take longer. The reason they do is they have shareholders to keep happy. They have boards that they have to run this all through. And a lot of times there's less willingness to actually invest up front in some of these processes. So a phase 1, phase 2 approach typically is not as common. It's not always the case, but it's much more common on the private equity side. On the strategic side, they typically are able to pay more. And the reason they're able to pay more is because they're kind of buying down some of the synergies, meaning if you have your EBITDA and you have your multiple, both private equity and strategic are trying to think through what synergies are in place. The management teams are typically more important to private equity, less important to the strategic. So the strategic is willing to share some of those synergies a little bit more on the back end. So a lot of times they're going to be able to overpay in some situations because of the fact that they're looking at much longer term hold periods. They don't have to report back to the same level of investors that private equity would, where they're going to have, a shorter, call it 4 to 6 year hold period. One other thing I want to add here, when we talk about the accelerated diligence, I talked more about phase 1 and 2. One thing I'm also seeing on the private equity side is the willingness to bypass some diligence. I've never had a corporate where they said, Joe, let's just do the bare minimum to get by. But on the private equity side, I've had multiple call me and say, you know what, let's scale back. We feel good about this business. We think we're getting a good deal for it, for what the environment brings right now. Let's only do the bare minimum diligence required to get this thing closed within the next few weeks. In the past, that would come up occasionally. I've had that 4 times in the last 2 months where people have asked me can you do these procedures very minimal and get it done in the next 2 weeks? If so, let's do it. We want to try to get this thing closed in the next, call it 4 to 5 weeks. That stuff just wasn't happening a few years ago. So I think that's one thing that's changed quite a bit right now. All right. So moving on to the next slide here, I'm going to turn it over to Tom to talk a little bit about what you've been seeing and what you've been advising your clients for the PPP.
Thanks, Joe. Before we dig into that, another question for you, and that is, do you think the current market situation and valuations and so forth are here to stay? Or maybe I'll say, do you have any insight as to whether that's a long-term, if not permanent? And if not, what lever or levers might be out there that'll change it back to historic valuations?
If I had a crystal ball, I think I'd be far better off than I am today. But from a valuations perspective, if we look back, we've seen growing trends where they've continued to go up, and a lot of that's because it's been more competitive. Private equity has been kind of a game changer to the M&A market in the sense that the funds out there is what's making it so it's more competitive. Your A assets have always traded very well, and they always will trade well. It's when you get down to the B and C assets, that's when you're going to be, they need more work. They're the ones that you have to get your hands in there and actually do, maybe change systems, put a new management team in. Those are the ones where I think the valuations are there's probably going to be a bigger spread between the A's and B's than what there have been in the past. So I think the A's will continue to grow. I think the others are going to be more of a market dynamic where I think things will normalize a little bit, but I also don't think we're going to see a fall off of a cliff. I think the one thing that we don't really know what the impact will be is the potential change in taxes. If capital gains go from 20% to ordinary income, then will valuations go up enough to make up for that spread? I don't think so. I think there's always going to be a disconnect there if that happens, but time will tell.
Thank you. Okay, we'll get back to the PPP, the Paycheck Protection Program, and I'm going to assume everyone on this call probably understands at least the big picture with the PPP. I know I personally spent 2 weeks straight on Zoom calls with clients and others back when this first came up. And everyone knows that there were tons of uncertainty. A lot of that's been cleared up now, and still, in some regards, still a moving target and so forth. So first off, starting with the accounting piece of it, GAAP does not address this directly, but the guidance provided allowed for some different treatments on how you record this. And in my experience, most for-profit entities anyway chose to follow the debt treatment of recording the PPP proceeds, which means you park them as a liability until you receive forgiveness from the SBA. So for many organizations, that might mean that all the expenses were incurred in 2020, of course, but you might not recognize revenue in 2020 until 2021. But that's the easy part. I mean, that's just the accounting side. But how might that play into transactions and so forth? Well, I can tell you from my own experience, it's unique to each organization. I've had several clients sell and a few acquire some businesses here since COVID started. And I saw one example where the buyer required the seller to pay back the PPP loan, even though it was totally legit and would have been forgivable. That was just considered part of the deal. The buyer was one that was a large entity and simply didn't want to have anything to do with it. And this was back several months ago now. So when there was a lot more uncertainty out there. More recently, maybe as recently as a couple of months ago, the biggest uncertainty in the deal was the taxability side of things. This was before the feds clarified that it was going to be tax-free from a federal standpoint. And at that time, this was a pass-through entity, an S corp, and it was going to make a big difference what happened with that. So it was actually written into the deal on how that would affect purchase price depending on taxability and so forth, and the funds were even put into an escrow. And now you've got PPP round 2 and some other things going on that'll continue to move the target. And Joe, I know you've got some insight here too. I will say our firm's advice on the PPP all along, well, throughout 2020 had been, unless you have a compelling reason, don't submit for forgiveness. And take a wait and see, and that proved pretty fruitful for some organizations because of recent legislation. Now, we had said all along, the biggest compelling reason you might have is if you're anticipating a possible transaction coming up, because if that's the case, well, then it's better off to go ahead and get that application and hopefully get it taken care of so it won't interfere and be one more thing to deal with. And then one last comment on the taxability side of things. The feds fortunately did take action and clarified that it'll be tax-free, the forgiveness. However, do know that the states are still all over the place. Some follow federal automatically, but some states, as of now, are saying that's going to be taxable, others not taxable. So we'll need to stay tuned on that. And just know that that issue hasn't entirely been resolved. So I'll turn it back to Joe.
Yeah, from a deal perspective, I think what Tom said kind of hit the nail on the head here. What I'm doing when I come in and look at these businesses, whether on the buy or the sell side, really the things I'm focused on is, did you record any income related to the PPP? If so, we need to strip that out. We get it that it may make up for some lost income during the year, but the PPP proceeds, they truly are non-operating, non-recurring, kind of the definition of what we present in EBITDA adjustments. That hasn't always been the most popular in transactions, but it's the nature of it. That's how it works. As far as the liability out there, we've been calling this debt-like because it is debt. It may be forgiven, but buyers aren't wanting to assume this risk. So if forgiveness hasn't been granted yet, we're calling this debt-like for all intents and purposes. That's what it is. The challenge with this is a lot of financial sponsors, they don't want anything to do with these types of funds. Private equity's gotten a very bad reputation right now when it comes to receiving any of the free money from the government. So because of it, most don't want to take it on. And that's where a lot of sensitivity comes into it. As much as people haven't been applying for forgiveness because that's been what they've been advised to do. In the case of a transaction, a lot of times you want to get that forgiven so that you don't have to call it debt-like and take away some of your proceeds after post-close, call it indebtedness. So that's where some of the sensitivity comes in. I've seen a few unique structures. I worked on a merger in September where basically both businesses were coming together. They took all the proceeds, put it into a holdco with restricted cash. Once forgiven, that restricted cash came back into the new, or I guess it had been the new co. It went in there as restricted funds for corporate allocations. If forgiveness wasn't granted, those funds would stay there to pay it off. So again, it was something where you're taking the liability plus cash to satisfy in the event they're not forgiven. I've seen a lot of them where, to Tom's point, buyers are making it where the sellers have to pay it off. They don't want to have any potential liability or risk associated with it. The last thing I'll talk about here is the payroll tax deferral. A lot of people took advantage of that. So one thing we're trying to do is we're trying to normalize for that. We're trying to make sure that earnings are representative of what they would be on a normalized basis. We don't know what travel is going to look like. We don't know what advertising and marketing spend may look like. So in those cases, we're not going to present adjustments because it's just too early to tell. But payroll taxes, we know those are going to have to be paid. So we're calling any deferred portion debt-like, and we're also normalizing for the portions where that expense wasn't paid. And then anything more deep than that, into operations and whatnot, that's where it becomes a lot more challenging and more of a science, or more of an art than a science. So next, we're going to talk a little bit about valuation impacts. What we're talking about on the left side are just different factors. So when we go down here, these are just different things that's going to impact valuation. When we go in the middle, these are different options related to it. So as an example, we have a deal structure. You can take minority or majority, and then you can include rollover equity. In these cases, right now, sellers are being given the opportunity to maximize returns. And by doing, the way they're able to do that is by rolling some equity or using earnouts. And the reason we're seeing these more and more popular right now is that the buyers want the sellers to put some skin in the game to kind of share in the risk of these maximum valuations. But that's how you start seeing some differences between how deals are structured and the returns you're getting. As we work down the list, you could go through each of these in detail and talk about the obstacle on the right side. But I think what makes the most sense, we talked a little bit about A asset versus B or C and kind of the differentiator between that multiple gap. If we were to look at an A asset, what I would put in that situation is it's a stable company that has clean financials, a very strong management team, has been able to grow their business year over year despite the pandemic, maybe down a little bit this year, but they've still been able to maintain and grow. They don't have customer concentration issues, have an element of recurring revenue, and they've been able to show the proven track record of doing an acquisition and integrating that acquisition and realizing synergies. That is kind of your definition of an A asset in a high growth business. Now, once you start peeling back any of those layers, that's where the quality goes down. So if we were to look at the same asset, but say their financial statements aren't solid, everything else is there, but the financial statements aren't solid, and they've never had a quality earnings, they don't have audits or reviews. In those cases, it's a lower tier asset, so the multiple is going to go down a little bit. It's more work that the potential buyer has to do. So what we typically see with, these are pretty subjective areas, but that's where you start seeing a mismatch in valuation expectations. That's where you see timing delays. There's always a risk of new ownership having some sort of issue from a customer or vendor perspective. And anytime that you're starting to have questions around the financial statements or the credibility and your quality of earnings, that's where you start having a risk of potential deals dying. Tom, any questions come in related to this at this point?
And we can launch a poll at this point. Thank you.
And as that poll comes out, yeah, Joe, we've got several questions, and I'm learning here that in the Zoom, not only do you have the chat, but you've got a separate Q&A. So I've got them both pulled up and toggled here. I'll address. Let's bring up a couple of the questions here, and then we can save others for the end. One was, can we get a copy of the presentation? I believe that is available or will be made available afterwards. There's a question with regard to the triple P for buyers regarding the not wanting to take responsibility for it post-close. And the question is, why should a seller not file for forgiveness before closing? And I'll take the first shot at that, Joe, and you can add on. But I would say in that case, you should file. To my knowledge anyway, you should file for forgiveness before closing. Ideally, you get it resolved before it even gets to that point so that perhaps you can even get forgiveness. But again, the background was going back into earlier 2020 when there was so much uncertainty, and many firms, including ours, were saying take a wait and see, because things may very well change or get clarified, and that did in fact happen. For some organizations that otherwise wouldn't get full forgiveness by waiting, they now have more eligible expenses provided by recent legislation, for example. That will allow them to have more forgiveness. So taking the wait and see paid off for many organizations. But with regard to transactions, perhaps not. Joe, do you have anything more to add on that?
No, I think the only thing I'd really add here is you got to remember a lot of people were going they were taking the advice of their lenders too. And a lot of lenders, they didn't want people to file for forgiveness yet. They were, just like Tom said, they wanted to take that wait and see approach because they didn't know. And the uncertainty is what's created the timing issues, because now most people understand the process better. We're seeing forgiveness being granted prior to transactions happening. I have 3 sell-side projects in the market right now. All 3 of them had PPP. They've all requested and they've been granted forgiveness. But they didn't start to go through that process until they knew they were going to be going to market. And they figured out what the going to market timeline was, and they waited as long as they could to make sure that some of these matters were resolved. But they knew that this would be created. There would be a challenge created if they didn't apply for forgiveness.
Okay, and some other questions. Joe, what average multiples do you expect to see for a healthy, growing ESOP company or companies in 2021? Can you venture any comments there?
So anytime you get into very specific multiples in industries, or ESOP's very different than a traditional transaction. Any of those, I would usually point to investment banks are the best source of that information, because they've constantly got their finger on the pulse. They know what's going on, and they see what deals are trading at. If you go to traditional precedent transactions, or what we do in a business valuation sense, that's a different situation than what fair market value of an M&A transaction would bring, because you're using history versus forward looking. In the ESOP transaction, that's different in itself, because that's not necessarily going with a traditional M&A. So valuations are typically lower from a multiple perspective than what they would be in any of the other industries that's going through traditional M&A. So not much of an answer on this one, because I don't have my finger on specific industries and getting further segmented down to ESOP versus anything else. But I would say that I rely on the investment banks for that quite a bit. The cliche is always 6 to 8 is what you can expect. If you're a good growing business, you would expect more. If you're in the technology space with recurring revenue, you can be up there to the 18 to 20s. I know some business services right now, specific in pest control type businesses, those are trading for 18 multiples. So it's all over the board.
Okay, and one more for now, also with a specific question here. And Joe, have you seen anything or anything you can look into the crystal ball with regard to M&A in the nonprofit healthcare market, especially hospitals and clinics, given the numerous financial challenges?
So one thing we see in healthcare right now is a lot of consolidation. Now, getting into the not-for-profit space, it's even more challenging. That's not an area that we spend a ton of time, because it's very different. I'm on a couple of boards right now that have gone through similar type transactions, and it's a very different process. It's very collaborative, which is a good thing, but there's not much for kind of setting the stage for multiples or activity. I do think we're going to continue to see more consolidation in healthcare, and I think that stay true for not-for-profit as well. But I couldn't speak to specifics for multiples, but I think it's going to continue to consolidate, which means activity will still continue to be high.
Okay, that's what we had for questions at this time.
Perfect. I'm more than happy to talk about any of these things in more detail. People have specific questions offline. But with that, Tom, I'll turn it over to talk about RevRec for a little bit.
All right, another favorite topic for everyone, I'm sure, revenue recognition, commonly referred to as ASC 606, which is the codification reference under FASB. By now, I'm guessing those that have GAAP-based financials have already implemented this. We do have a few clients that, because of COVID, were allowed to delay it 1 year and are still in the process with this. But I'll assume for the most part, people are familiar with what ASC 606 is. There's an overview here on the slide screen. And here's some of the observations I have from transactions that have closed or been in process over the last several months. I'll share with you here. First off, revenue recognition, especially on the my comments are from the seller side mainly. So if you're considering a sale or partial sale or even raising more funds, I think this is really important. Revenue recognition has always taken an area of emphasis in due diligence. So when a prospective buyer is coming in and they turn their due diligence team loose, you can expect to get a lot of questions and really get raked on your revenue recognition. So that was even before 606. But I think that picked up even with 606 because of the significance with it. It was new for some organizations. It did significantly change their revenue recognition, especially if you're in the software licensing space where it may have expedited revenue. So some of my observations is that it's going to continue getting increased emphasis. I recommend that you make sure you understand your ASC 606 positions. And by that, I mean, you don't ever want to say, well, our auditor told us this, or I don't know, that's just how it shows up in the financials, those sorts of things. You want to know what your positions are and be able to clearly state them. And even if you're not a GAAP basis, if you don't prepare GAAP basis financials, so if you don't have an auditor review, or even if you do, if they're cash basis, it's still not a bad idea to understand what your positions would be under 606 because a buyer is going to want that. And they're going to be digging into that. So the more you can have teed up in that regard, the better. And to help you understand it, or maybe as a part of the understand it, absolutely make sure you've got your positions documented in a memo, in a checklist, something like that. It's pretty hard to say you really understand all your positions if you don't have them documented anyway. But you can certainly present a much more confident reply when you've got them documented. And of course, you've got something to refer back to them on. Some recent examples I've seen is that, and what was interesting is these came up post-close. Maybe to Joe's point where he's seen the due diligence pre-transaction in some cases has maybe been expedited. Maybe that's what's being reflected here because in the examples I'm thinking of, all this information was provided during the due diligence and questions did not come up. And then after the close, they were drilling down into the weeds on revenue recognition. And fortunately, on the ones I was involved in, there was real solid documentation that we had helped the client with and served as their position. And so that the buyer clearly understood their position. And at that point, it was up to whether they agreed with the judgment that went into that. And by the way, in case you didn't know, or maybe as a reminder, there is a ton of judgment that you're able to use under revenue recognition, which makes it all the more important that you document these judgments that were made and positions you've taken. Those are the comments I've got on that. Joe, what have you seen out there?
Yeah, from a quality of earnings perspective, really what we're focused on is making sure our periods are comparable. You know, if they implemented 606 in 19, so we're looking at 18, 19, and 20 as our historical period, then we don't have an apples to apples. We need to be able to at least understand the impact to 18 as well, or we need to pull out the impact for all periods. So one thing we're always looking for is a comparability between periods. Now, as we move into 2021, 18 becomes less relevant. We're typically doing 2 full years plus the trailing 12. So because of that, we aren't going to have as many issues because a lot of people are doing this, pushing it back. So because you're trying to do the beginning balance for equity purposes. So we're seeing less of an impact there, but we really look at the documentation to understand how are these transactions presented. I've been in transactions where the sellers are adamant they're doing things correctly. So we start digging into margins, and the natural one that always comes up is going to be percentage of completion, job-based accounting. And in those cases, we go back and start looking at the monthly impact of margins, and you just see a roller coaster ride. Nothing's consistent at all. And we're seeing negative margins to skyrocketing margins. What that tells me is there's something wrong in the accounting. Even though you've documented your basis correctly, even though you have an audit at the end of the year, we look at things monthly in the quality of earnings world. Because of that, we go back and start looking at it, and you can see there clearly wasn't a good matching of revenue and expenses. We're going to want to present adjustments in hindsight. We're going to acknowledge that maybe on an annual basis everything works, but we don't use a level of materiality typically. So because of that, there's going to be tweaks. What we see in some of these transactions is people speed to get to the finish line and say, hey, we're going to deal with this on the back end, put some money in escrow to make sure that we're protected afterwards, and close. And what happens is then that creates disputes. Disputes become more expensive. No one likes them, and it creates challenges once you go past the close period.
Okay, and Joe, we do have a few more questions, and we have about 10 minutes left total. So we'll save the questions coming in now until the end.
Okay. So the last slide is just talking about deal timeline and processes, just to get you a little more familiar with this. I mentioned that private equity typically has about a 9-month process. It really comes down to, if you're selling a business, when do you start having those discussions about a transaction? It's really, what do you want? What's the best bet for you, your family, for the business, the management team, everyone that needs to be considered. If it's to do a broad auction process, you should start talking to advisors early. One thing that's notorious with any type of advisor, myself, investment banks, any consultant, is we're notorious for giving free advice. And a lot of times, all these relationships, they need to be built over time. And you need to go with the party that you can work with the best, because none of these processes are just real quick and easy. They can be in a proprietary world, but typically if you're using an investment bank, that's a relationship you should nurture over time and get to know, because you're going to be working very long, hard hours to get this transaction closed. Once you kind of settle on your plan, you'll go to market, you'll receive some initial bids, there'll be some kind of kick of the tires diligence, you'll get an LOI signed, so letter of intent. In those cases, none of these, whether it's an initial offering or a letter of intent, none of those are binding. They're not legally binding, but what they do is they give you some comfort that this is the valuation. The goal is always not to have retrading, because that's when everyone feels like they've been, slighted at that point. So you want to do the best you can to kind of put your best foot forward, make sure that you're being truthful, true with yourself. Diligence usually would pick up anything that you're not telling the truth on anyway. So we always say, be yourself, tell the truth, and support everything with facts, because everyone wants it's more of a fact-based business. Once you get through diligence, it turns into negotiations and signing the deal. And then you get into the post-close. The post-close is where you'd have to start transitioning the business. You have earnouts, you have net working capital true-ups, you have any sort of disputes that may come out of it. The best way to avoid disputes is get ahead of all of it, put yourself in a position so you understand working capital, you understand the purchase agreement, it matches what you want, it matches what the buyers are expecting, and everything can sync a little more seamlessly. With that, bring on any of the questions that we have.
Yeah, Joe, we've got some questions here on similar themes. One is, it speaks around what do you recommend for sellers in terms of preparation or due diligence? Like, for example, should they engage a firm to perform sell-side diligence? And I'm going to piggyback on this with my own question and observation. I know many investment bankers and others will suggest if you can have audited or reviewed GAAP basis financials for 1 or 2 years in advance, that puts you in a better position. I know I've had some examples where buyers have required that, and resulting in our clients engaging us to do 2 years worth on very short notice. But what are your thoughts on that, Joe? And how far out in advance should a company be starting preparations? It's a lot of info there. Sorry.
No, I'll take this as 3 different questions. I think I can break this down 3 different ways. First, let's talk about a timeline to kind of go through the process. What I say is it's never too early to have conversations. I'd mentioned about people giving free advice, whether it's myself advising from a financial perspective, whether it's an investment bank advising on what's your best exit opportunity. The earlier you start having those conversations, the more people you meet and talk to about it, the better shape you'll be, the more you'll be prepared. So I always say it's never too early to have some of those conversations. Now, there's always an element of confidentiality, not wanting word to get out in the community that you're looking to sell. I get that. That's where, having good NDAs, and again, most of us are all really good about signing the NDAs, and we don't talk about it because we don't talk about it internally for these reasons. It's confidential and there's liability there. So it kind of, the main story is never too early. Now, related to audit versus reviewed and leading into a transaction, we talk about A assets. A assets are those assets that have tight financials, they're clean, and they're ready for buyers to just basically take over the business. Audits and reviews give people more comfort around the financials. So what we typically will say is it's never necessary to do the work for what we're doing from a quality of earnings perspective, because we do diligence on a lot of businesses that don't have audits or reviews. What I would say is the more professional you are, the better position you're going to be in. If you have a good KPI dashboard, if you have a good management team, you have audited financials, and you have a quality of earnings, you're likely going to have a lot better valuation. You're going to have a much better likelihood to close a deal, and you're going to be much better prepared than if you went into the transaction without any of those. So it all comes down to preparation. On the sell side, there's really 3 reasons you get a sell side: speed to close, certainty to close, and maximum valuation. The speed to close comes into play when the buyers come in, they're going to ask for a lot of data. If you've gone through the sell side process, you've already prepped for that. They're going to ask you a lot of questions. On the sell side, you would have already prepped for most of those questions. The certainty to close means someone's already taken a deeper look into your financials. They're not necessarily a third party in the sense that you're still paying them, but what is happening is they're taking that objective, credible look with a dedicated team of M&A advisors that know this stuff. They do it all day, every day. They can help position you on working capital, on debt-like, come up with counter arguments that aggressive buyers are going to come with. And then the third piece is the maximum valuation, which goes into what I just talked about on debt and debt-like, but also going to help you set a working capital peg, and it's also going to make sure that you get paid for any of those identified adjustments that a buyer may not identify or may not tell you about after you've received the LOI. So, I'm obviously biased. I do quality of earnings work, so I think it is a must. And I'll tell you, most of the banks I work with really strongly suggest it. The key is not getting too aggressive on your adjustments. If you do, then there's no reason to pay someone to do a quality of earnings, because if you're getting too aggressive on it, the buyers aren't going to believe what's in that report anyway and say they weren't objective.
Okay, and another question. Can you compare and or contrast the difference? What's the difference between an investment banker and a firm such as ours that offers transaction advisory services?
So an investment banker is a FINRA licensed broker-dealer, basically, is the way to look at it. Their job, they'll typically are going to be on the sell side, but they'll also have buy-side engagements or mandates that they may have. They're going to be paid a retainer and have success fees. So the investment bank's job is to take you to market, get you the highest dollar maybe not highest dollar is not the right word, but they could bring you the highest dollar, but really to match your wishes with what potential buyers have. So we talk about a broad auction process. That's going to be through an investment bank. They're going to help you get prepared. They're going to get together as a marketing material to go out to market, and they're going to do all the contacting. They're going to have people write the indication of interest. They're going to summarize that for you. They're going to be the point of contact for all the potential buyers. It's going to take a lot off your plate, so you don't have to manage that process. They'll help you through the decision process, etc. What firms like ours do, so what we do the quality of earnings work. It's not going to be success fee. It's based on a set arrangement based on an estimate of time and expenses. But what we're doing is we're taking a deeper look into the financial statements to make sure there's no accounting or finance errors. So again, rev rec's off. You're accounting for, you're not doing proper accruals. You have issues with the out of period adjustments, or your inventory accounting is incorrect. We're going to take a deep look at that and restate the financial statements for buyers so they're prepared to look at that. What it does is it gets ahead of any issues that may be out there and helps position you better for that. So it's two very different things, but all kind of centered around M&A in a way. And we typically work a lot with investment banks.
Okay, and we've got a couple others I think we can get in here. So with regard to quality of earnings, excuse me a second, I'm going to answer that question there. With regard to quality of earnings, they're subject to a non-reliance letter, and so that buyers cannot rely on the work. In other words, there's not an opinion or anything given on that, I think is what that means. So in that case, so if you engage your own, or perform your own due diligence, is that going to avoid the buyers engaging their own advisors to do it anyway?
It's not. So what typically happens, the buyers are going to engage a third party regardless. And I shouldn't say it all the time, but 90% of the time they're going to engage someone. The non-reliance letter really is to explain to everyone that this is not an audit, it's not a review. We took financial information from the systems, and we did not do any procedures to test the accuracy. It's all based on analyticals, right? We talked through the trends, we had a basic understanding, we didn't come across anything that created significant issues to us. And what we're telling someone is, here's our data book, here's the report. You can use that as the base, but just know these aren't audited financials. It's very different. We're not expressing an opinion on these. So it's really a liability, kind of a protector for anyone that's doing the work. Same thing with lenders when they get the diligence reports. They get the same access letter or non-reliance letter, but that's what it is. It's really kind of a piece of liability to explain that we did not do an opinion, we did not issue an opinion, we did not go through an audit procedure. This is based on what we know about the business and based on the financial information available to us.
Okay, and with 1 minute to go, we've got one question. I think this will be a short one. At what size transaction do you generally get into the electronic data room environment? And I'm going to take the first stab at that, Joe. I see it 100% of the time now, at least by the time it gets into the due diligence. And it's more just I guess, a convenient and secure way to do it. You don't have to use one, of course, but there's so much confidential data flying around that allows you to upload and provide authorizations and so forth. So, Joe, do you have thoughts on that as well?
All I'd say is rarely do we not see them, and typically it's through either a private equity firm, us having our own, or the investment bank. Okay,
and it looks like we're right at time. So I guess that I'll turn it back to Roseanne or Nancy, and if there is any follow-up questions, we can follow up offline on those. So thank you, everyone, for attending today's session.
Thank you, Tom, and thank you, Joe, for your intellectual property knowledge that you shared with your FEI members today. We do want to remind our attendees that the CPE email notification will be sent in 7 to 10 business days when the credits are available. Thank you very much to all our attendees for joining us this afternoon, and we do wish you the best of the afternoon. Have a great day.